heck of a close into the weekend, but I think some month end, some rebalancing, maybe a little technical effect might have been at play. The key message from this week is that we saw the limits of AI's reach. Firstly, in cloud companies and software stocks on earnings that have been talking about a big game for AI but didn't have any numbers to show it. When you can't pump up your guidance to match the way you've pumped up your job owning, you're going to get hit. And that looked justified and overdone. We also saw that there's a competitive element within the subject of AI that suggests these mega cap companies are going to have to compete with each other, and so a rising tide may not lift all boats the same. And so what you saw was a little breakdown in our mega cap trade. What you can basically summarize this week with is looking at the equal weight index for the S&P. What we got was kind of an inverse of the recent theme. Throughout most of this year, of course, it's been highly concentrated strength in AI names that's driven the index, the market cap weighted index, up. It's the equal weight that's been the laggard. Recall, the equal weight index failed to make a new high when we bounced back this month. So we know that this is the broader look at the market. And so to see this week some relative strength actually from equal weight in the second half tells you how different this week was. You saw value trades doing well. You saw breadth improving, but the market cap weighted index is under pressure. Of course, with the exception of that crazy ramp into the close. But this is an important situation, because if you lose the mega cap driven market, if you lose the LLM euphoria, the chat GPT euphoria, then you really start to lean on the macro more. Look at the way the chat ETF from Round Hill got hit. Now, it's still up a ton since the debut. Obviously, this has generally been a rewarding trade, but this is a pretty clear rejection from the previous high. So you've put in now a lower high in the big Mag 7 chat trade connected to the whole AI revolution. And now what that means is if that trade's on a break, even if it's not selling off, if it stops going up, then that shifts the pressure over onto the macro. Recall we started this week with my risk radar putting the green light on the dollar. I might have jumped the gun there a little bit on that, but the point that I wanted to communicate was that there's a lot of reasons to see dollar support in an environment where the inflation data and the implications of our economy are still supportive for interest rates and still supportive of a higher for longer regime. Also, the dollar catches a bid when stocks are under pressure. If you look at the way the dollar and rates traded here this week, we caught the bid in the dollar on Friday, even though inflation wasn't hot, because stocks got pressured. So that's why I have the green light on the dollar. And I think going into next week, that's where we want to keep our mind, because it's going to require something very powerfully dovish or powerfully strong without inflation to give us something to run with if we don't have the big tech trade. Now, who knows? Maybe the Friday ramp was just people buying the dip, and we'll see big tech and the Nvidia trade power back up and carry us to victory next week. But with so much economic data, I think our focus should still be on rates and the dollar. And by the way, the 2-year yield had a pretty hard rejection this week. So if it bounces back with conviction, then you're going to have macro problems. If it doesn't, if it stays subdued, then we might see some real rotation like we did this week. Maybe the broad market could do better. Have a great weekend.